Ajit, hello. Hello, Rivers Cutter.
Yes, sir.
We'll wait for some time, no?
Yes, sir.
Only 7 participants are there.
Yeah, we'll wait for 5 minutes. How many participants, sir, in commerce?
Almost 16 are there, but active only 12, 13 are there, sir.
Okay, okay.
Management 6 only, no?
Yes, sir. 6, sir.
All are active.
Yes, sir. All are active.
Anyway, I am only the host. If you want, you can. If you have some other work, you can leave, sir. No problem. We'll manage.
I'll give you intro, then
Yes.
I'll be there, sir.
Okay. Because I am only the host.
Yeah,
If any
okay.
problem is there, I have connected with you. I'm in college only. Where are you, sir?
Yeah. I'm at home, sir.
Okay, no. I'll manage, sir. No problem.
Yeah, okay.
What's the sir?
Yes, sir.
What's the do?
Sir?
Only 10 participants are there. That means only 8 only is there, no active participants. Because I am only 7 are there, sir.
Yeah.
Because one admin is there,
Yes,
yourself and
sir.
myself. Only participants are 7 only.
They'll join late, I think so, sir.
Yes. Only half an hour break now.
Yeah.
What will we wait or something?
They'll start, sir. Let them join, sir, one by one.
Okay. Because admin maybe sometimes they'll will go. Maybe you are forward, no problem. Okay. Yes, sir. We'll start. Otherwise, simply wasting 10 minutes over.
Yes, sir. Very good evening, participants. Uh, Today we are having Professor Raghavendra Babu as a resource person for this session. Sir has completed M.Com and MBA, and Sir also has cleared NET. And Sir is expert in finance and banking. Sir is having 9 years of teaching experience and 3 years of industry experience. Today we are going to have a wonderful session from Professor Raghavendra Babu. Welcome you, sir.
Thank you, sir. Thank you very much.
It's over to you, sir. You can continue.
Okay. Good evening, participants. Can you hear me? Sir, can you hear me?
Yes, sir.
Okay. Okay, we already the last 7 classes or 6 classes over already in the commerce, 5 classes I think. Okay, they already discussed about banking, discussed about management process. Okay, they already discussed human resource management and international business. Okay, so my paper is financial management. Okay, if you have any questions in between also you can ask. You can unmute yourselves. Okay, you can unmute in any time and you can ask or you can type the message in the chat box also. Okay. Okay, so before going to the topic, so what is management? So management is an art of getting things done through others. Okay, so what is financial management? So financial management is a functional areas of the one of the functional areas of the management. So what are the functional areas of management? So what are the functions of management? Planning, organizing, staffing, directing, and controlling. So what are the functional areas of management? Any idea? What are the functional areas of management? Anybody? Anybody know what are the functional areas of management? You can unmute and you can answer. Students? Okay. The functional areas of management are financial management, production management, HR management, uh, marketing management. So financial management is one of the functional areas of management. So what is meant by financial management? Okay, financial management in the net, they have 8 to 10 questions they are going to ask and each carries 2 marks. Okay, so what is financial management? Financial management is that managerial activity which is concerned with planning and controlling of firm's financial resources. Okay, in simple words, it deals with financial decisions, investment decisions, dividend decisions, and working capital management decisions. Okay, financial management deals with planning and controlling of financial resources of an organization. Okay, what is financial decisions? So what is meant by financial decisions? So, so what is meant by financial decisions? Any idea? Okay, so financial decisions deals with how much funds required for the organization, so how company is going to manage with those resources, how company is going to raise, whether it is long-term sources or short-term sources, okay, how much is the cost of capital, what is the capital structure of an organization, and how company is going to choose the long-term sources of an organization. So that is only known as financial decisions. So financial decisions deals with allocation and raising of funds. So financial decision deals with allocation, that means raising of funds and how company is going to raise those funds with various long-term sources of funds. That is nothing but financial decisions. Okay, what is investment decisions? So after raising funds, the company is not going to keep money in the bank account. So there are various sources of funds, maybe equity shares, preference shares, debentures, whatever may be the mode. So company is not going to keep in the bank account. They are going to invest in some projects. So what is investment decisions? Investment decision deals with application of funds. Financial decisions deals with raising of funds. Investment decisions deals with application of funds. So what is dividend decisions? So dividend decisions is nothing but, what is dividend? Dividend is the portion of profits earned by the company. Dividend is the portion of the profits earned by the company. Okay, what is dividend policy? It shows the relationship between retained earnings and total profits. Dividend decisions varies from organization to organization. So dividend is the portion of profits earned by the company. And what is working capital decision? See, financial decisions deals with how much funds required for the organization, how company is going to raise those funds, and what is capital structure of an organization. Okay, and what is investment decision? Whatever funds raised through financial decisions, they are going to invest in investment decision. They are going to invest in various projects. And what is dividend decision? It is a portion of profits earned by the company and it will be distributed to equity shareholders or other shareholders, preference shareholders. And what is working capital management decisions? Working capital management is nothing but funds required to manage day-to-day operations of the business. So working capital may be required for fixed working capital or fluctuating working capital or short-term working capital or long-term working capital. So these are four decisions are components of financial management. So in simple words, financial management deals with financial decisions, investment decisions, dividend decisions, and working capital management decisions. Okay. I hope all of you understood the meaning of financial management. Financial management is that managerial activity which is concerned with planning and controlling of financial resources. In simple words, it deals with financial decisions, investment decisions, dividend decisions, and working capital management decisions. Okay, next is objectives of financial management. So there are mainly two objectives of financial management: profit maximization and wealth maximization. What is profit maximization? The profit maximization means earnings of the company. Suppose company earned last year 1 lakh rupees, or this year company earned 1,50,000 rupees. So how company achieved 1 lakh to 1,50,000? And how much company is going to pay the shareholders? And what is earnings per share? In detail, we'll discuss later. What is earnings per share? Main objectives of financial management are profit maximization and wealth maximization. So profit maximization is a short-term goal. So profit maximization in financial management represents the process or approach by which profits or earnings per share is increased. In simple words, all the decisions, whether investment or financing, are focused on maximizing the profits to optimum levels. Without profits, companies cannot sustain in the business. So profit is the lifeblood of the business. Funds are the lifeblood of any organization, whether it is educational institution or maybe a banking institution or any financial institution or non-financial institution or a company. So without profits, company cannot survive in the market. So profits is a basic objective of any organization, not only financial management. Profit maximization is the basic objective of any organization. Okay, how company can achieve profit maximization? So what are the ways to achieve profit maximization? So how the company can achieve profit maximization? What are the ways? What are the ways company can achieve profit maximization? So any answers? What are the ways to achieve profit maximization? Students, you can unmute yourself and you can answer. You can unmute and you can answer. So how company can achieve profit maximization? What are the ways a company can achieve profit maximization, the goal of profit maximization. Students, you can unmute and you can ask, you can answer the question. How company can achieve profit maximization? Anybody? Harivaskar sir? Hello? Harivaskar sir? Am I audible? Hello? Students, you can unmute and you can answer. Hello? Harivaskar sir? Harivaskar sir? Okay. Charu, you can unmute and you can answer the question. Hello? Charu Pawar, you can unmute and you can answer the question. Okay. So there are so many ways to achieve profit maximization. So one way is increasing selling price. Increasing. Okay, no issues. Okay, no issues, no issues, no issues. Okay, thank you. No problem, no problem. Okay. How you can increase profit maximization? How you can achieve profit maximization? By increasing the selling price. But this is ruled out. How? So you cannot simply increase the selling price, because in this competitive world, simply if you're increasing selling price, suppose a product is having 10 rupees in the market, you are selling 10 rupees per product in the market, and you cannot increase simply 12 rupees. There are competitors and they are also selling at 9 rupees, 9 rupees 50 paisa at same quality, and you increase selling price from 10 to 12 rupees, okay? So there is no demand for the product. Automatically demand decreases, because same product, same quality, you are simply increasing the selling price. So automatically your sales decreases, profit decreases. But how you can increase or achieve the goal of profit maximization, or how you increase the sales? By reducing the cost of production. The main way to achieve the objective of profit maximization is if you can reduce the cost of production, or reduce the wastage of resources. Reducing the wastage of resources or reducing the cost of production. Again, how you can reduce the cost of production? Simply you cannot reduce the cost of production, because there are totally two types of cost: variable cost and fixed cost. Suppose if you decrease variable cost, automatically production also decreases, because variable cost varies according to production of sales. If variable cost increases, okay, automatically the total variable cost increases. That means the variable cost increases means production of sales increases. If production increases, variable cost also increases. But which one you have to see? Fixed cost. Because, hello? Participants, please mute yourselves. If you have any doubts, you can unmute and you can ask questions. Okay, simply you cannot increase selling price. You want to achieve the goal of profit maximization, you can reduce the cost of production. How you can reduce the cost of production? So fixed cost is come into picture. Because while calculating the cost of a product, fixed cost per unit cost is taken into consideration. Per unit cost is taken into consideration. So per unit cost, so per unit cost taken into consideration. So if fixed cost per unit reduces, automatically, okay, the cost, the total cost, fixed cost remains same, but the contribution of each product in the total cost of the product reduces, because fixed cost will not vary according to the production or sales. If variable cost increases, okay, total variable cost also increases, cost of the product also increases. But fixed cost, what is the meaning of the fixed cost? Fixed cost remains same whether raw material increases or whatever may be the issue, fixed cost remains same. Variable cost includes the cost of raw materials, cost of the rent of the building, okay, electricity, okay, lubricants. Variable cost, production increases, all these costs increases, automatically the cost of the product increases, but fixed cost remains same whether raw material increases, your production increasing from 10,000 units to 20,000 units, cost per unit remains same. Suppose if you're increasing 10,000 units to 20,000 units, variable cost increases, but fixed cost remains same, cost per unit remains same. Suppose you are producing 10,000 units, if cost per unit fixed cost is 5 rupees, it will be distributed to 10,000 units. Suppose you are increasing 10,000 units to 20,000 units, so cost per unit will reduce to 50%. Automatically you can save money. So that is how you can achieve profit maximization. You can achieve the goal of profit maximization. How many ways you can achieve profit maximization? Reducing the cost of production, or reducing the wastage of resources, or optimum utilization of resources. Okay, what are the advantages of profit maximization? So without profits, you cannot measure the performance of an organization. If you want to measure the performance of an organization, you have to see the profits. It is a barometer. It is a measuring instrument. Profit maximization is a measuring instrument through which the performance of an organization is observed. Then profit maximization enables shareholders, they can invest more in the organization. Without profits, there is no dividend. If company earns profits, earnings per share increases. Out of earnings per share, company is going to pay dividend to the shareholders, automatically increases the confidence of the shareholders. Okay, these are the advantages of profit maximization. And what are the disadvantages of profit maximization? Any idea? What are the disadvantages of profit maximization? Participants? You can unmute and you can answer. What are the disadvantages of profit maximization? So advantages are, it increases the confidence of the shareholders, regular dividend to shareholders. It is a barometer through which performance of the organization is measured. What are the disadvantages of profit maximization? Any idea? You can chat in the box also. Monopoly. Okay, monopoly. Any other answers? Any other answers? What are the disadvantages of profit maximization? The main disadvantage of profit maximization is, see, we are talking about profits, profits, profits. Which profits we are talking? Is there any clarity? Which profits? And here, one disadvantage is it ignores time value of money. It ignores time value of money. So what is time value of money? According to time, the value of money also increases. Suppose you are investing 1 lakh rupees today. After 1 year, you are receiving same 1 lakh rupees. So where is the time value of money? Interest rate. Suppose you are investing 10,000 rupees in a bank. Bank gives, in savings account also gives 4% interest. You are investing 10,000 rupees. Bank will give 400 rupees annually. So that is time value of money. But in profit maximization, so no time value of money. It ignores time value of money. And one more disadvantage, there is no clarity about the profits. Hello? Anybody?
അടുത്ത പാർട്ടാണ് ഇത് തുടങ്ങിയത്. ഇപ്പൊ സൗണ്ട് കുറച്ചതിന് കൂട്ടിയത്. അടുത്ത പാർട്ട് സെക്കൻഡ് പാർട്ട്. ഞാൻ ഫസ്റ്റ് പാർട്ട് ഞാൻ ഇവിടെ വന്നത്, സെക്കൻഡ്
Hello? Okay. So I muted all because in between disturbance. So better you will chat in the message box if you have any doubts, or if I ask any question, if you can answer in the chat box. Okay. What are the disadvantages in profit maximization? The main disadvantages, which profits is taken into consideration, is not clearly mentioned. So we are talking about profits. Which profits are taken into consideration? So you're calculating sales, gross profit, net profit, profit before tax, profit after tax, economic profit. Which profit we are taking into consideration? So that is not clearly mentioned according to the concept of profit maximization. So it is not a clear concept. And it ignores time value of money. The present value of cash inflows are not taken into consideration. That means only book value is taken into consideration. See, suppose you are receiving 1 lakh rupees after 1 year. So what is the value today? That is time value of money. Suppose you are receiving 1 lakh rupees after 1 year. What is the value today? That is time value. But in our concept of profit maximization, they are totally ignored. And it unnecessarily increases the problems from the say, employees. If company earns profits, suppose there is no guarantee that company earn profits. By manipulation also you can increase profits. By adjusting depreciation, you can show more profits, or reducing the book value, or reducing the market value of the assets, you can show more profits. It is in the hands of the auditors. If company is not considering time value of money, you can manipulate the accounts. If totally we are ignoring time value of money, if company is not actually earned profits, but they can show profits in the profit and loss accounts to only satisfy the shareholders of the company, they can manipulate the accounts, and it unnecessarily increase the corrupt practices by the top level management to satisfy the shareholders. But actually company is not earned profits. At the same time, employees demand more salaries because profit and loss account showing profits, but actually companies not earn profits. So that is the case. If they demand more salaries and fringe benefits, how company will pay more salaries to the laborers or employees unnecessarily? So it leads to strikes and lockdowns. Okay, so these are disadvantages of profit maximization. And what is wealth maximization? What is wealth maximization? So what is wealth maximization? See, wealth maximization is totally considers the time value concepts. See, wealth maximization means to earn maximum wealth for the shareholders. Finance manager tries to give a maximum dividend to the shareholders. And also same time, it tries to increase the market value of the shares. The market value of shares is directly related to the performance of the company. And here everything is taken into consideration about market value of the assets, and the companies try to increase the wealth of the shareholders. That means prices in the stock market. If the price in the stock market increases, so automatically shareholders are benefited. How company can achieve wealth maximization? By considering the time value of money. And wealth maximization in this concept is very clear. It is considered only present value of cash inflows. So what is present value of cash inflows? That is net present value. NPV is taken into consideration. What is NPV? We'll discuss later. So wealth maximization directly correlated to the present value of cash inflows. So how company can achieve wealth maximization? To increase the value of the shares in the stock market. Here, more than more than the book value of capital. So market value of capital is taken into consideration. Market value of assets is taken into consideration. Suppose company purchased 1 crore rupees worth of assets last 10 years back. Now also they are showing same 10 crore rupees in the balance sheet. So that is not the current value of the assets. That is not the time value of money. So now they have to show the market value of the assets. Market value maybe they purchased 1 crore rupees 10 years back. Now maybe 3 crores, 4 crores, or maybe 10 crores. Depends on the various factors influencing on the value of the assets of the organization, whether increase or decrease. So automatically wealth of the shareholders increases. How they can achieve the wealth maximization? So by taking into consideration the time value of money, and also to increase the value of the shares in the stock market, so they can achieve wealth maximization. So what are the advantages of wealth maximization? It attracts more investors because there is a clarity. You invest 10 rupees per share last year, now it is 30 rupees. It leads to capitalization, increase in the value of the shares, and same time company paying dividend to shareholders. So one side dividend, other side the increase the market value of the shares. So total investment is increasing day by day. But in profit maximization, they tries to earn only profits. Out of the profits, they are going to pay some amount to the shareholders as dividend, and they are not going to consider time value of money. Okay, and wealth maximization concept directly correlated with the market value of the shares. If market value increases, wealth of the company increases. Wealth of the company is nothing but wealth of the shareholders. Okay, so that is wealth maximization. It is a clear concept. Okay, it consists time value of money. Okay, and it attracts new investors, and gives it gives clear cut dividend policy. It gives, okay, that means company can fix clear cut dividend policy. So management will have a freedom to fix a clear cut dividend policy for the shareholders because it considers time value of money. The main aim is to earn, okay, market price, to take more share in the stock market. Okay, that is wealth maximization. Okay, there are 4 components in financial management. One is financial decisions, investment decisions, dividend decisions, and working capital management decisions. So we have MCQs on financial decisions, investment decisions, dividend decisions, and working capital management decisions. Okay, they'll ask questions only on these 4 decisions. Okay, what is financial decisions? So financial decision is a process which is responsible for all the decisions relating to with the liabilities and stockholders' equity of the company, as well as issuance of bonds through proper financial planning. So financial decisions is nothing but how much funds required for the organization, how company is going to acquire those funds, what is the cost of the capital, and they try to minimize the cost of the capital. Okay, and at the same time, so they need a proper financial planning. So financial decisions deals with how much funds required for the organization, how company is going to arrange those funds, not more than this. The financial decisions deals with how much company required funds, how much funds company required to start the business or to expand the business, and how company is going to arrange those funds, whether it is through equity shares, preference shares, debentures, or only equity share preference shares. So that is only known as financial decisions. How they are going to manage financial decisions, that is only through proper financial planning. What is financial planning? Financial planning is the process of estimating the capital required and determine its composition. Sorry, it is not competition, it is composition. Financial planning is the process of estimating the capital required and determining its composition. What is composition? It is the combination of various sources of long-term funds: equity capital, preference capital, debentures. So equity capital, preference capital, and debentures. It is a process of estimating the capital required and determining its composition. Suppose there are 2 types of capital required in the organization. One is fixed capital and working capital. One is long-term capital, one is short-term capital. How company is going to manage short-term capital? That is only through working capital. That means short-term funds. Short-term funds are invested in working capital. Long-term funds are invested in fixed capital. That is, fixed capital means capital expenditure. What is capital expenditure? Capital expenditure is the amount we are going to invest in the fixed assets, and it will not give returns immediately. It will take time to recover the cost of the assets or whatever fixed assets. Okay, so that is capital expenditure. It is expenditure company is going to take to recover more time. That is capital expenditure. So long term, they are going to raise long term funds to invest in the capital expenditure, and they are going to raise short term funds to manage working capital. So financial planning is the process of estimating the capital required, both working capital as well as fixed capital. So how company is going to manage fixed capital? Fixed capital means, okay, land, building, machinery. So how much funds required for the organization? How company is going to raise those funds to invest in the capital expenditure of fixed assets? Generally, equity shares, preference shares, debentures. Now, how company is going to manage working capital? That is through short-term sources of funds. That is bank overdraft, cash credits, okay, trade bills, trade credits. That is how company is going to manage, okay, long-term long-term requirements as well as short-term requirements. Okay, so what are the objectives of financial planning? See, financial planning is mainly determining capital requirements, short-term as well as long-term, and determining the capital structure, the capital required, that is equity share, preference shares, debentures, and we're framing strong financial policies with regard to cash control, lending, borrowings. That means how much company can borrow money from the banks, financial institutions, how much company can borrow debentures from the public. It is all financial policies determined by the top level management. So what is the main aim of financial planning? So determining capital requirements, how much funds required for short term, how much funds required for long term. So determining capital structure, the capital structure is the composition of the capital. That means designing the capital structure. What is capital structure? It shows the relationship between various long-term sources of finance. What are long-term sources of finance? Equity shares, preference shares, debentures. And one more main objective is framing strong financial policies with regard to cash control. That means how much is outflow of cash, how much is inflow of cash, how much cash required in the organization to manage day-to-day operations of the business, and how much company can lend, how much company can give credit to the suppliers or vendors, or maybe say credit, okay, sales, okay, how much company can lend, bills, receivables, debtors, and how much company can borrow funds from the banks through cash credit or current account or maybe bank overdraft. So that is clearly designed through financial policies that is done by top level management. The main objective of financial planning is determining the capital requirements, determining the capital structure, and framing strong financial policies. What is financial planning? Financial planning is nothing but determining the capital requirements, determining the capital structure, and required financial policies they have to design to manage capital requirements and capital structure. That is the objectives of financial planning. Okay, next concept under financial decisions is cost of capital. See, while raising capital, simply company cannot raise capital. Suppose company required 100 crores of equity capital. Maybe company required, total capital required is 1000 crores. On what basis they are going to decide how much is the equity shares, how much is the preference shares, how much is the debentures? Because what is cost of capital? Cost of obtaining funds. It is the rate at which company must earn to satisfy the shareholders. It is the rate at which company is going to pay to the shareholders. It is the required rate. It is the expectation of the shareholders. What is the cost of capital? It is the expectation of the shareholders for investing in the organization. So there are generally there are three types of capital called equity capital, preference capital, debentures. So what is cost of capital? Cost of obtaining funds. It is the required rate of return. It is the expectation of the shareholders, debenture holders, preference shareholders to invest in an organization. Okay, what is the cost of equity capital? Anybody can chat? Anybody can give answer? What is the cost of equity capital? What is the cost of equity capital? Anybody can answer? What is the cost of equity capital? Okay, the cost of equity capital is dividend only. So what is the cost of, you can chat in the message box, chat box. Haribaskar sir? Hello? Any participant can unmute and tell me, am I audible? Hello? Hello? Okay. Okay, what is the cost of equity capital? Anyone can please chat? Message me, or you can unmute. I already unmuted all. You can yourself unmute and you can answer. You can unmute yourself and you can answer. Yeah, dividend. The cost of equity capital is dividend. But it is not the fixed rate of dividend, it is fluctuating dividend. Okay, what is the cost of preference shares? Right, cost of equity capital is dividend, but it is not the fixed rate of dividend, it is fluctuating dividend. What is the cost of preference capital? What is the cost of preference capital? Anybody? Only few are active. Fixed rate of dividend, correct. The cost of preference share capital is fixed rate of dividend. Okay, what is the cost of debentures? What is the cost of debentures? Interest, correct, exactly. The cost of equity capital is dividend. What the cost of preference capital is fixed rate of, right. All are answering, all are active. Good. I appreciate everybody. Okay. Cost of preference capital is fixed rate of dividend. Cost of debentures is interest. It is the main duty of the financial manager to reduce the cost of capital. To reduce the cost of capital. How they can reduce the cost of capital? By applying the techniques of financial management. By evaluating each type of capital, and they are going to select the capital. So cost of equity capital may be 8% and it is not fixed. It varies from organization to organization and year to year, and there are various policies to fix the cost of equity capital. That is dividend, because all the companies will not pay the same dividend every year and it is not fixed. There are so many factors influencing on payment of dividend to equity shareholders. What is the cost of preference capital? Fixed rate of dividend. That's why companies generally raise more equity capital and moderate preference capital and less debentures. Why? Because the cost of debt is interest, fixed rate of interest. Whether company earn profits or not earning profits, company has to pay interest to debentures. But cost of preference capital is fixed rate of dividend. Suppose company earns profits, company will pay dividend to preference share capital, even though it is a fixed rate of dividend. Suppose company is under loss, company will pay dividend. Yes or no? Guys, suppose company is under loss last 3 years. So preference shareholders will get dividend. You can check. Yeah, no. Why? Because dividend is the portion of the profits earned by the company. It is not the loss. Dividend always defined as dividend is the portion of the profits earned by the company. It is whether it is a fixed rate of dividend or it is fluctuating rate of dividend. Dividend always is the portion of the profits earned by the company, not the loss. But the cost of debentures is always fixed. Interest rate, whether company earns profits, whether company is not earning profits, company has to pay rate of interest annually or whatever may be the terms and conditions between debentures and company is going to pay interest to debenture holders. If company is under loss, then there is no other way. They have to sell the assets and they have to pay interest to debentures. Because there are different types of debentures. Mortgage debentures, secured debentures, unsecured debentures. If company is not paying, they'll claim the charge on the assets of the organization. Okay, so cost of debentures is fixed rate of interest. Cost of preference shares is fluctuating rate of fixed rate of dividend. Cost of equity capital is fluctuating rate of dividend. Yeah, only except cumulative preference shares, company, there is an option, company is going to pay dividend in the future years. Okay, we'll see what are the different types of preference shares later. Okay, well, long-term source of finance. Okay, so only except cumulative preference shares, all other preference shareholders, okay, there is no fixed rate of dividend. Whenever company earns a dividend, okay, whenever company earns dividend, company will pay dividend. Okay, so that means suppose company this year no profits, company is under loss, no dividend to even though preference shareholders, even though dividend rate is fixed, but only cumulative preference shareholders. So suppose company is under loss this year, next year company is going to pay dividend to cumulative preference shareholders. Okay, cumulative, that means arrears, they are going to get arrears of dividend. So that is okay, cumulative preference shares. So that is okay, cost of capital, cost of equity capital, cost of preference capital, cost of debentures. So what is cost of equity capital? Cost of equity capital. So what is cost of equity capital? So what are the factors influencing? What are the factors you are going to consider to calculate cost of equity capital? So students, please answer. You can unmute. You can unmute and you can answer. So I already unmuted. You can unmute and you can answer. So what is cost of equity capital? What are the factors you are going to consider to compute cost of equity capital? Students, or you can message. So you can unmute. Anybody? One candidate already unmuted. Vidya, sorry. Okay, nobody is ready to answer. So what are the factors you are going to consider to compute cost of equity capital? Very simple. Okay, so they are the okay, risk, okay, equally sharing factors, profit, preemptive rights. Okay, so mainly there is direct factors are okay, direct factors. See, it is the composition of So see, dividend per share. So how much company is going to pay dividend to equity shareholders? So what is the market value of equity shares? So what is the growth rate of the company for last 1 year or 6 months or for 3 years, 4 years? And what is the earnings per share? So these are the factors influencing on cost of computing cost of equity capital. Based on these factors only, we are going to derive okay, The formulas for cost of equity capital. Cost of equity is equal to DO by PO plus G. DO is dividend per share, PO is price per share, and G is the growth rate of the dividend. And one more is that cost of equity is equal to earnings per share, E is the earnings per share, and PO is the price per share, and plus G is the growth rate of the dividend or growth rate of the company. So based on these four factors only, the formulas are divided. By applying these formulas, okay, you can compute what is the cost of equity capital. Suppose company earns 2 rupees dividend, company pays 2 rupees per share, and company already having, okay, price per share is 5 rupees or 10 rupees. What is the cost of equity capital? So based on the dividend, based on the market value, based on the growth rate of the company, based on the earnings per share, by applying these two formulas, you can compute cost of equity capital. What are the factors influencing on cost of equity capital? Dividend per share, market value of share, growth rate of the company, and earnings per share. Okay. So shortage of time, I took only cost of equity capital. Okay, what is capital structure? What is capital structure? It is the composition of various long-term sources of finance. We already discussed. Okay, it is the combination of equity shares, preference shares, debentures. Okay, earnings before tax divided by value of the firm. Okay, there are so many formulas are there. Okay, based on various factors, we can apply the formulas. Okay, so this is the value of the firm. Okay, correct. Cost of the equity shares. Okay, so you can apply various formulas. So it varies from organization to organization or author to author. Okay, you can calculate. There is so many. These are the basic formulas I mentioned. Okay, okay. So K is equal to DB by value of the firm. Okay, yes, nice. Okay, okay. Thank you, sir. Nice, right answer. Okay. So cost of voting rights also taken into consideration. Okay, size of the firm. Okay, there are so many factors influencing on equity shares. Okay, so what is capital structure? It is the composition of various long-term sources of finance, equity share, preference shares, debentures. So what is the difference between capital structure and capitalization? Capital structure is book value of equity share, book value of preference shares, book value of debentures. Maybe the preference shares and debentures book value remains same. So there is no difference. So preference shares value, so because preference shares are not listed in the stock market, debentures also not listed in the stock market. Only equity shares are listed in the stock market. The value increases day by day. Depends on various factors influencing. Okay, demand of the shares again depends on the performance of the company. Okay, natural calamities, again recession, inflation. Okay, there are so many factors influencing on the equity shares. Only equity shares are listed in the stock exchange. Okay, and preference shares always shown the book value. Debentures always shown in the book value, but equity shares are listed in the stock market. That leads to capitalization. So that means the securities are measured at market value. Capitalization is equal to total outstanding securities into price per share in the market. That leads to capitalization. See, currently everybody looking for capitalization. See, equity shareholders are not mainly looking for the dividend paid by the company. That is very less percent. So those who are mainly going for investment, they'll see the dividend. And most of the shareholders mainly do speculation. What is speculation? Buy today, sell today. So trading only for short period of time, taking the advantage of fluctuation in the prices. That is speculation. So that leads to capitalization. Total outstanding securities into price per share in the market. What is the price change? That leads to capitalization. So capital structure shows only book value, whatever you are going to show in the balance sheet. The balance sheet never gives market value of the equity shares. So only stock market gives correct value of the equity shares. That is only known as capitalization. Suppose you purchase 100 shares of Infosys at 1,000 rupees last year. Maybe now the value of each share is 1,500. equity capitalization is 50% growth, 50% increased. Your capital is increased from 100 to 150%. So that is capitalization. So all the shareholders are looking mainly capitalization. So what is capital gearing? So capital gearing is a ratio, is a useful tool to analyze the capital structure of a company and is computed by dividing the common stockholders' equity by fixing interest or dividend bearing funds. That means it shows the relationship between own funds and borrowed funds. What is capital gearing? It shows the relationship between owned funds and borrowed funds. Own funds means equity funds. Equity funds includes reserves, surplus, retained earnings. Okay, so equity capital plus retained earnings plus reserves. Okay, so that is equity funds divided by debentures plus preference shares. Debenture capital plus preference capital. So that leads to capital gearing. See, if suppose company is having more equity capital, then company is having less debentures and less preference shares. Suppose company equity capital is 35 lakhs and debenture plus preference shares is 30 lakhs. Okay, that leads to low gearing ratio. Suppose company is having less equity capital and company is having more debentures and preference shares, that leads to high gearing ratio. It shows the relations between owned funds and borrowed funds. It leads, okay, that is capital gearing. When company will have low gearing ratio, company must have more more equity shares, more equity funds than debentures and preference capital, that is low gearing ratio. What is high gearing ratio? Suppose company is having debenture capital of 10 crores, preference capital of 30 crores, total borrowed capital is 40 lakhs and equity capital is only 30 lakhs. 30 lakhs divided by 40 lakhs, 0.75. That is high gearing ratio. High gearing ratio. Okay, so because the debt and preference shares, okay, debt and preference shares is more than equity funds. Okay, that is capital gearing. So okay, one of the other tool to manage capital structure or to analyze capital structure or to manage the risk involved in the business, okay, that is leverage. There are two types of risk involved in the business risk and one is financial risk. So what is business risk? Anybody can answer? What is business risk? There are mainly two risks involved in the business. Okay, so this is a tool to manage business risk and financial risk. Leverage. Okay, so what is business risk? Anybody get a message? What is business risk and what is financial risk? So leverage is a tool to manage business risk and financial risk. So you can manage business risk and financial risk. Okay, first, what is business risk? Tell me. Any participant? What is business risk? What is business risk? Any participants? Hello? Financial is related to money and cash investment. Business risk is controllable risk, right? Okay, example for business risk. Raising of debt or equity is financially, exactly, absolutely right. Rashmi madam, right. Debentures. Yeah, debentures, cost of funds is financial risk. Interest, mainly interest is the financial risk. You cannot control. Okay, what is the example for business risk? Example for financial risk is interest on debentures, correct? What is business risk? Which are controllable, uncontrollable, internal, external. Example, tell me example for business risk. Very simple. variable cost and fixed cost. Variable cost and fixed cost. Okay. So business risk mainly deal with variable cost and fixed cost. Financial risk mainly deal with interest on debentures. Okay. So what is leverage? Leverage, circumstances that bring an additional income to an organization. That means by by increase variable cost or fixed cost, or a decrease interest or increase interest, or the decrease dividend on preference shares or increase dividend on preference shares. Okay, company can manage business and financial risks. The circumstances that brings an additional income to an organization is only known as a leverage. Simple example, leverage means lever. What is the meaning of lever? It is a gear. It is a gear. See, if you take a gear of a car, suppose any up comes, automatically you will increase, okay, or reduce the gear. Or you want to increase the speed, okay, automatically you will speed up the car or a bike, okay, automatically increase the lever, gear. First gear, second gear, third gear, fourth gear. So same thing. Leverage means circumstances that brings an additional income to organization by taking into consideration business risk and financial risk of an organization. Okay, there are three types of leverage: operating leverage, financial leverage, and combined leverage. Okay, what is operating leverage? So operating leverage. What is operating leverage? Please, students. What is meant by operating leverage? BSNL business risk, changes in technology. Okay, what is operating leverage? What is operating leverage? Okay, operating leverage is the tool to calculate business risk. Operating leverage used to compute business risk. Financial leverage tool to compute financial risk. To evaluate financial risk, you are going to apply financial leverage. If you want to analyze business risk, you are going to apply the operating leverage. And what is combined leverage? To manage both business risk and financial risk. Okay, that is combined leverage. Correct, exactly, both. Operating leverage into financial leverage, you will get combined leverage. So if you want to manage business risk as well as financial risk, you have to apply combined leverage. And what is the basis for calculating these three leverages? What is the basis? Is there any basis to calculate all these three leverages? To derive formulas? Is there any can be used to decide which option is the best one to raise capital, either equity or debt? Exactly, correct. Okay, what is the basis for calculating these three leverages? What is the basis? Is there any basis to compute operating income? Correct. How are you going to get operating income? EBIT, correct. Operating income is nothing but EBIT. How you are going to derive EBIT? How you will get the EBIT? How you are going to derive EBIT? Operating income is nothing but EBIT. Correct, exactly. That is the master table. One master table is there. Okay, master table to compute leverages. So what is that? Master table to compute leverages. See, sales as per, this is the master table to compute leverages. Sales minus variable cost. Sales minus variable cost, you'll get contribution. Contribution minus fixed cost, you'll get EBIT. EBIT minus interest on debentures, you'll get EBIT, earnings before tax. Less tax, you'll get earnings after tax. Less dividend on preference shares, you'll get earnings available to equity shareholders. Okay, what is operating leverage? What is operating leverage? What is the formula for operating leverage? Okay, this is the formula for operating leverage. So operating leverage is equal to contribution by EBIT. Contribution by EBIT. Contribution by EBIT. You will get operating leverage. Contribution, okay, by EBIT. Earnings before interest and tax. It is also known as operating income. Contribution by EBIT. This is a master table to compute leverages. So you need to remember the master table. Okay. So to compute leverages, contribution by EBIT is the operating leverage. Okay. What is financial leverage? EBIT by EBT, earnings before interest and tax divided by earnings before tax. So what is financial leverage? Earnings before interest and tax divided by earnings before tax is the financial leverage. Okay, what is combined leverage? Combined leverage, there are two ways to compute combined leverage, very simple. First calculate operating leverage, then calculate financial leverage. Operating leverage multiplied by financial leverage, you'll get combined leverage. Or, okay, multiply the formulas, you can derive combined leverage. See, combined leverage is equal to operating leverage into financial leverage. What is the formula for operating leverage? Contribution by EBIT into financial leverage, EBIT by EBIT. Okay, cross multiply, EBIT gets cancelled. You'll get contribution by EBIT. Sorry, that is contribution by EBT. This is wrong. Contribution by EBT. Contribution by EBT. So operating leverage formula, financial leverage formula, you'll get contribution by EBT. Contribution by EBT. Correct. Yes, right. Contribution by EBT. So by applying these tools, you can reduce business risk and financial risk. Suppose company is having more operating leverage, that means company is having more business risk. Suppose company is having more financial leverage, that means company is having more, okay, interest on debentures. So company is tries to reduce financial leverage because it is uncontrollable. That is the case, they have to reduce debentures, because debentures also, they have different types of debentures: redeemable, irredeemable, okay, secured, unsecured. Some debentures is having maturity period. Okay, after maturity period, company can redeem the debentures. Automatically financial leverage reduces. So suppose company is having funds, they can reduce the financial leverage. And how they can manage operating leverage? By adjusting the variable cost and fixed cost. See, variable cost. If variable cost increases, contribution increases. If contribution increases, EBIT increases. Anyway, fixed cost remains same. You cannot control fixed cost. If variable cost reduces, okay, automatically contribution reduces and fixed cost remains same. Automatically earnings before contribution is more, fixed cost remains same, automatically EBIT increases. Okay, so this is the master table to compute leverages of operating leverage, financial leverage, combined leverage. Leverage means circumstances that brings an additional income to organization by adjusting various factors in the capital structure. Okay, master table. Okay, you can increase profits by applying financial leverage, operating leverage. Okay, tools, adjusting variable costs, interest on debentures, or dividend on preference shares. Okay, you can maximize the profits of an organization. Okay, so that is what is earnings per share. It is also a tool, okay, to manage the capital structure of an organization, to reduce the, okay, to increase the returns of shareholders. Okay, company is going to calculate earnings per share. How you are going to calculate earnings per share? Earnings per share is an important financial measure which indicates the profitability of a company. It is calculated by dividing the company's net income with its total number of outstanding shares. The higher the earnings per share of the company, the better is its profitability. So what is this earnings available to equity shareholders? How you got this? Earnings available, which one you have to take? Earnings available to equity shareholders. Any answer? Which earnings you have to take? Earnings available to equity shareholders. It is EBIT you are going to consider? Or EBT we are going to consider? Which one? Earnings after tax we are going to consider. See, EPS is calculated only for equity shareholders. EPS is calculating only for equity shareholders. So EPS, how you are going to calculate? What is this EAT, earnings available to equity shareholders? Not only after deducting tax and interest, one more obligation is there. What is that? One more obligation you have to deduct. One more obligation. After one more obligation, that is earnings available to equity shareholders. See the master table again. See earnings before tax, less tax, earnings after tax, less dividend on preference shares. Because preference shares having preferential right to receive dividend before equity shareholders. After payment of dividend to preference shareholders, okay, exactly right. Preference shareholders dividend we have to deduct. Then you will get earnings available to equity shareholders. That is taken into consideration. EPS is equal to earnings available to equity shareholders divided by number of equity shares. You will get earnings per share. So earnings per share is directly correlated with profits of an organization. If company earn more profits, more EPS. Anyway, that leads to profit maximization. Okay. So next concept. Any doubts regarding financial decisions? You can ask. Any doubts regarding financial decisions? Financial decisions deals with raising of funds, how much funds required for the organization, how company is going to arrange those funds, how company is going to design capital structure. Okay, what are the source of long-term funds? And what is the cost of capital? Okay, what is operating income? How company is going to manage business risk and financial risk? So the main objective of financial manager, main duty of financial manager is to reduce the cost of equity capital. Why? It is the expectation of the shareholders. It is the expectations of the investors. Cost of capital is expectations of the investors. If company is not able to satisfy the investor, company cannot sustain the business. The main aim is to increase the confidence of the shareholders as well as investors. For that, they are going to evaluate through financial planning. So financial decisions deals with financial planning and also arranging of funds, how much funds required, how company is going to arrange funds, and through leverages, through cost of capital computation, through EBIT analysis, EPS analysis. There are techniques used in financial decisions. EPS analysis, EBIT analysis. Okay, year to year they can compare the EBIT. Suppose company sales increases from 1 lakh to 2 lakhs. What is the EBIT? Last year company had a sales of 1 lakh. This year company had 2 lakhs. And variable cost also increases. Fixed cost remains same. And company debentures increases from last year 2 lakhs to this year 3 lakhs. What is the effect on EBIT? So by preparing master table only, you can analyze the EBIT, increase or decrease. By applying various techniques, you can analyze the capital structure. One is cost of capital, computation of cost of capital, computation of leverages, and computation of EPS, computation of EBIT. So you can analyze the capital structure of an organization. So financial decisions mainly deals with capital structure of an organization. Okay, next is investment decisions. This because some companies simply raise funds and they are not going to keep in the bank accounts. So they are going to invest. Next step is investment. So what is investment decision? It is also known as capital budgeting. Capital budgeting is the process of making investment decision in fixed assets or capital expenditure. We already told capital expenditure means it is an expenditure and company may require more time to recover the cost of the fixed assets. That is only known as capital expenditure. Expenditure company cannot recover in a short span of time. That is known as capital expenditure. In simple words, it is the process of evaluating the project proposals. So company will not invest in any projects. Maybe company requires land, building, machinery. So company raises capital through equity shares, through IPO. Company raises capital to preference shares, debentures, they analyze capital, they reduce cost of capital. Okay. Okay, suppose company capital is 5 crores, equity capital 2 crores, debenture capital 3 crores, preference capital. So company estimated EPS is 10 rupees per share in the next 4-5 years. So simply company is not going to invest in the project. Company already having money, but they are not going to invest immediately. So next step is investment decision, that is known as capital budgeting. What is capital budgeting? It is a process of evaluating the project. They are going to see the feasibility of the project because they are not investing. All the people already know. So joint stock company, if you take joint stock company, if owners are different, management is different. Management is managing owners' funds. That is not their own funds. So they have to take care to manage the funds. Before investing, they have to see the feasibility of the project, whether the project gives necessary returns or not. Within the project, there are necessary returns to recover the cost of the project is more important. That's why they have to evaluate the projects before investing. So capital budgeting is the process of evaluating the project proposals. Before investing, they have to evaluate the projects. That is only known as capital budgeting or investment decision. Financial decision deals with raising of funds, and investment decision deals with application of funds. Okay, before investing, how they are going to evaluate the project? So there are the 5 steps involved in the capital budgeting: project generation, project evaluation, project selection, project execution, and follow-up. So generally they'll ask questions on these steps. Okay, and also we have questions on cost of capital. We have MCQs on EPS. We have MCQs on leverages. Okay. Project generation. What is project generation? So generating new ideas for the business. See, how ideas are generated in an organization, whether it is a new organization or existing organization, how ideas are generated? Anybody can answer. How ideas are generated in an organization? In new organization, how ideas are generated? In existing organization, how ideas are generated? So capital budgeting is a process of evaluating new projects or project proposals. So how they are going to choose the projects? What is the first step? Project generation. What is project generation? Generating ideas for the business or generating new ideas or new projects for the business. Simply they'll take one project and they're not going to invest. They're going to choose several proposals. How proposals are generated? Anybody? How ideas are generated in an organization? How ideas are generated in an organization? Anyone please charts? How ideas are generated in an organization? Please message me. How ideas are generated in an organization? Hello? Am I audible? Please message me in chat box. Am I audible? Hello? Hello, am I audible? Yes, okay. Okay. How ideas are generated? Anyone? Anybody knows? How ideas are generated in organization? Brainstorming sessions, experience, used by the others. Very simple. For a new company, how ideas are generated? Conferences, seminars. Okay. So direct sampling. That means meeting the customers. Okay. So they'll generate the ideas. They'll take the views from the customers if the company is customer oriented. The conferences, or they'll take the feedback from the correct feedback, and also they'll evaluate the competitors. their products, their projects. Then what else? They'll take the help of research institutes. Okay, so that is for new company. Existing company, how ideas are generated? Existing company, how ideas are generated for existing company. Help with the idea sellers. Existing company. Okay, so direct marketing. Correct. Right. So direct marketing. Then the ideas are generated maybe top level management, middle level management, lower level management, even conferences, seminars, direct selling. Okay, that is a generate the ideas, whether it is a new project or they want to increase expand the project, or they want to increase the production, or they want to add a new product to the product line. If company is producing one product, we cannot call it as product line. Suppose company is producing more products, it is considered as product line. If company wants to add one more product to the product line, that is also a new project. So whatever may be the idea, so ideas are generated internally or externally. First step is generate ideas for the business. Then project evaluation, how you are going to evaluate the projects. First you are going to estimate cash inflows and cash outflows. How you are going to evaluate the project? You are going to evaluate, how you are going to evaluate, first estimate the cash inflows and cash outflows. There are two steps involved mainly in project evaluation. First step is estimate cash inflows and cash outflows. Then compare cash inflows and cash outflows. How you are going to compare cash inflows and cash outflows to evaluate the project? By applying the tools and techniques of financial management, you can evaluate or compare cash inflows and cash outflows. That is only known as project evaluation. Project evaluation is having two steps. One is estimate cash inflows and cash outflows. Okay. What is cash inflows? You are receiving. Revenue is cash inflows. What is cash outflows? Cost of the project. Cost. How much you are going to invest? Cash inflows is the revenue of the project. Cash outflows is nothing but investment, cost of the project. How we are going to compare cash inflows and cash outflows? That is only through applying the techniques of capital budgeting. What are techniques of capital budgeting? Traditional techniques and modern techniques. We'll discuss a little later. Okay. What are the techniques? Modern techniques and traditional techniques. So after comparing cash inflows and cash outflows, okay, the financial manager, generally mid-level management, are going to do, because they are specialized in the financial management. Okay, maybe board of directors, maybe even illiterate can also act as a board of director of the company. He is not having a knowledge to evaluate the projects. They'll take the help of financial managers, or maybe chief financial manager. Nowadays we call it as chief financial officer, okay, CFO. Okay, under the assistance of financial managers, assistant financial managers, okay, assistant managers, okay, financial clerks, financial analysts, and they are going to evaluate the project, compare, okay, cash inflows and cash outflows, and based on comparing cash inflows and cash outflows, they are going to check the feasibility of the project. So there are two techniques. One is traditional techniques and modern techniques. We'll discuss later. Okay, next is they are going to submit the report to the top level management. Who is going to submit the report to the top level management? Finance manager or chief financial officer. After preparing the report, the evaluation of the project, they are going to submit report to the top level management. And who is going to select the project? Board of directors. They are the ultimate decision makers in the organization. It's up to the board of directors, even though it is a feasible project. So there is no guarantee that they can select the projects. It is up to the board of directors' decision. So ultimately, project selection is done by board of directors. Okay. Next, project execution. What is project execution? Again, it is a duty of the finance manager to execute the project. Once the project is selected, done by the top level management, okay, project will be move to the mid-level management, chief financial officer, or maybe financial manager. They are going to execute the project. For that, what they are going to do? First, they are going to prepare a budget. How much funds required for the organization? How much investments required? How much investments for marketing department? How much investments for production? How much funds required for the production department, marketing department, human resource department? How many employees required in the organization? How many employees required in the finance department? How much funds required for each and every department? Based on that, they are going to okay, prepare a budget. And based on the budget, they are going to raise capital. And they are going to create a capital structure. How much is the equity shares? How much is the preference shares? How much is the debentures? Okay, then they are going to execute the project. They are going to raise capital and they are going to do investments. They allocate funds to each and every department, and then marketing manager, HR manager, production manager, they'll take care of the funds and they'll invest in the projects, their own department projects. Okay, that is project execution. Project generation is nothing but generating new ideas. Project evaluation is nothing but comparing cash inflows and cash outflows by applying tools and techniques of financial management. Project selection is selecting ultimate project by the top level management. Project execution is implementation of the project. What is follow up? What is follow up? Very simple. Comparing actual project with the planned project. Controlling, it is a function of controlling. What is controlling? Comparing actual performance with the standard performance, and to find out the differences, and if any differences are there, any deviations are there, to correct the deviations as and when occur. That is follow up. So timely reports they have to send to top level management. They have to compare the actual performance, the standard performance, and find out the deviations and try to correct the deviations. If they're not able to correct the deviations, they have to send a report to the top level management. Top level management board of directors, they'll take the decision. That is follow up. That is capital budgeting and steps involved in capital budgeting. So what are the investment appraisal? What are the methods of investment appraisal? I already told project evaluation. Project evaluation, we need techniques. How you are going to appraise the project? By using the tools and techniques of capital budgeting. There are mainly the techniques are divided into traditional methods and discounted cash flow techniques. What are the two methods? Traditional methods and discounted cash flow methods. Under traditional methods, payback period, accounting rate of return. Okay. And discounted cash flow techniques, net present value, profitability index, internal rate of return. Because of shortage of time, I took only two techniques. Okay. Net present value method, profitability index method, then internal rate of return method, okay, certainty equivalent approach, correlation, regression, standard deviation, decision tree approach. Okay, so many techniques are available to evaluate the cost, evaluate the feasibility of the project. What is the difference between traditional methods and discounted cash flow methods? Anyone can answer? What is the main difference? You can appraise the project by applying payback period, accounting rate of return. You can appraise the project by applying net present value, profitability index method. What is the difference between traditional methods and discounted cash flow methods? So what is the main advantage? And currently all are applying discounted cash flow methods only. So very rarely they are applying traditional methods. Okay, payback period and accounting rate of return method.
സാന്ദ്ര അതുകൊണ്ടാണ് കയറാത്തെന്ന് തോന്നുന്നു സെക്കൻഡ് ഗ്രൂപ്പ് ഞാൻ അയച്ചു കൊടുത്തപ്പോ മറ്റേ ആദ്യത്തിലുണ്ട്
എന്നിട്ട് അതും അവള് പറഞ്ഞില്ലല്ലോ അല്ലേ?
No, not the depreciation. Main difference is time value of money. The main difference is time value of money. Okay. Traditional methods, we are going to ignore time value of money, and discounted cash flow techniques, we are going to consider time value of money. Depreciation is taken. Depreciation is considered by all the methods. Depreciation considered in all the methods, but only difference is time value of money. In traditional methods, we are ignoring time value of money, and discounted cash flow methods, we are considering time value of money. Okay, so next we are going to each one discuss one by one. Okay, what is payback period? Payback period is the period in which project will generate necessary cash inflows to recover the cost of the project. Payback period is the period in which the project will generate necessary cash inflows to recover the cost of the project. See here, cash inflows varies from project method to method. Here, which cash inflows are we going to consider? Cash inflows refers to earnings before depreciation and after tax. Earnings before depreciation and after tax. How you are going to calculate earnings before depreciation and after tax? Earnings before depreciation and after tax. How you are going to calculate earnings before depreciation and after tax? Suppose company is having EBIT. Our company maybe is having operating profit. How you are going to derive earnings before depreciation and after tax? How you can convert cash flows into earnings before depreciation and after tax? Very simple. First, we are going to deduct depreciation, then deduct tax, then you have to add back. Why? Because without deducting depreciation, you cannot deduct tax. Without deducting depreciation, you cannot deduct tax. For the purpose of deducting tax, first you are going to deduct depreciation, then you are going to deduct tax, then you have to add back depreciation because we need before depreciation. Without deducting depreciation, it is not eligible to deduct tax. Only for the purpose of deducting deducting tax, we are going to deduct depreciation. First deduct depreciation, then deduct tax, then add back depreciation. You will get profits, earnings before depreciation and after tax. Because simply maybe you get doubt. Sir, instead of deducting depreciation, deducting tax, again you are adding depreciation directly, you deduct tax. Wrong. For the purpose of deducting tax, it should be earnings after depreciation. For the purpose of deducting tax, it should be earnings after depreciation. After deducting depreciation, it is eligible to deduct tax. For that purpose, first deduct depreciation, deduct tax, then add back depreciation. You will get earnings before depreciation, earnings before depreciation and after tax. Okay, the formula for payback period is cost of the project. Even in case of even cash inflows, what is even cash inflows? Every year project is generating same cash inflows. Every year project is generating same cash inflows. So payback period is equal to cost of the project divided by cash flows per year. Suppose cost of the project is 1 lakh rupees. Every year company is generating 20,000 rupees. Payback period is 5 years. In case of even cash inflows. Suppose company is generating first year 10,000, second year 20,000, third year 30,000, fourth year 50,000. You cannot apply this formula. You have to apply this formula. Years before full recovery plus required cash inflows divided by actual cash inflows. So payback period is a period in which the project will generate necessary cash inflows to recover the cost of the project. Here cash inflows refers to earnings before depreciation and after tax. In case of even cash inflows, in case of uneven cash inflows, okay, payback period is calculated. What is accounting rate of return? Accounting rate of return is also known as average rate of return. Average rate of return, it is the ratio of estimated accounting profits a project to the average investment. It is a percentage of returns to the investment. Very simple. It is the percentage of returns to the investment. It is a percentage of earnings to the investment. Only point is we are going to average. By averaging, we are going to consider earnings as well as investment. ARR is equal to average annual earnings divided by average investment into 100. How you are going to calculate average annual earnings? Average annual earnings is equal to total earnings divided by economic life of the project. That means earnings will be distributed to all the years. We have to average. So maybe if some 1 year company earnings is 50,000, second year 20,000, next year 30,000. Okay, that will be averagely distributed to all the years. That is average annual earnings. Total earnings divided by economic life of the project divided by average investment. Average investment, there are two formulas. One is cost of the project divided by 2. That is average investment. When you are going to apply this formula, in case there is no scrap value on working capital. So suppose there is a scrap value and working capital in the problem, we have to apply this formula. Average investment is equal to cost of the project minus scrap value divided by 2 plus working capital plus scrap value. So there are two formulas to calculate average investment. It is simply percentage of earnings to the investment. ARR is also known as accounting rate of return, average rate of return, or rate of return, simple rate of return. Okay, that is accounting rate of return. So that is two traditional methods. So totally ignoring the time value of money, that is net present value method. It is a discounting technique. So what is net present value? It is the difference between present value of cash inflows and present value of cash outflows. What is present value of cash inflows? What is the value of cash inflows today is taken into consideration. Not the before, not the future. What is the value of the cash inflows today? Well, maybe you are receiving 1 lakh rupees in the next year, July and June next year. You are receiving 1 lakh rupees after 1 year. That is 1 lakh is not taken into consideration. What is the value today? That may be less. It will be less. So by applying discounting technique, okay, you are going to calculate present value of cash inflows minus present value of cash outflows. Okay, present value of cash inflows is equal to cash inflows multiplied by discount factor. Present value of cash inflows is equal to cash inflows multiplied by discount factor. You will get net present value method. Net present value method. It is the difference between present value of cash inflows and present value of cash outflows. Okay, so that is net present value method. Here you are going to apply time value of money. So by discounting, so cash inflows multiplied by discount factor, you will get present value of cash inflows. What is the value today? Suppose cash inflows is 1 lakh rupees multiplied at 10% discount rate or 10% interest rate. Okay, so 10% interest rate we have to apply the formula. So that is generally 0.909. So 10,000 into 0.909. So what is the value today? You are receiving 10,000 rupees after 1 year at 10% rate of interest. That is 10,000. What is the value today? So that is, okay, 9,990 or 9,090 rupees. Okay, that is present value of cash inflows. 9,090 rupees you are invest today. So next year at 10% rate of interest, you will get 10,000 rupees. That is present value of cash inflows. You are receiving 10,000 rupees next year. What is the value today? That is only present value of cash inflows. Okay, so net present value shows the difference between present value of cash inflows and cash outflows. Okay, what is profitability index? Only simple difference is profitability index shows the relationship and net present value shows the difference. That is only difference. Okay, difference between net present value and profitability index. The NPV is the difference between cash inflows and cash outflows, and profitability index is, okay, relationship. It shows the ratio between cash inflows and cash outflows. Profitability index is equal to present value of cash inflows divided by present value of cash outflows. Here you are going to divide, there you are going to take difference. That is only profitability index and net present value. Okay, so these are the 4 techniques used to evaluate the projects. One is profitability index, net present value method, accounting rate of return method, payback period. Okay, these are the 4 techniques used to evaluate the project. Based on these techniques, okay, or any technique they can apply rate, standard deviation, coefficient of correlation, decision tree approach. If project is having more risky, they'll apply advanced techniques. Okay, so that is okay, investment decision. So that is, next is dividend decisions. We'll go fastly, we have only 15 minutes. Okay, We'll take some questions also. So what is dividend decisions? Dividend is the portion of profits earned by the company and will be distributed to shareholders. Dividend policy. What is dividend policy? It shows the relations between retained earnings and profits earned by the company. So dividend is a portion of profits earned by the company and it will be distributed to shareholders. It is a part of the profits, it will be distributed to shareholders. So what is dividend policy? It is the relations between retained earnings and the profit. It is the difference between retained earnings and the profits. Dividend policy varies from organization to organization. And dividend policy mainly including the financial policy of an organization. Financial policy is designed by top level management. So dividend policy is one of the concept of financial policy. So generally, what are the dividend policies company is going to follow? Generally, these are the dividend policies. It varies from organization to organization. Fixed dividend per share as the percentage of net profits. Okay, small dividend plus extra dividend as a percentage of market value. That means whatever will be the profits, company is going to pay dividend every year, same dividend. That is fixed dividend per share. As a percentage of net profits means some percentage on net profits. If net profits increases, dividend increases. If net profit decreases, dividend decreases. Directly correlated with the profits of the company. And third one is small dividend plus extra dividend. Suppose company profits are fluctuating more, they'll follow this method. Because company profits generally increase in seasonals. If you take crackers industry, only in the month of November, October, September. So because of Diwali as well as Ganesha festival, more demand for crackers. That is the case. So company cannot pay more dividend. That is the case. Company can pay more dividend. But other times, other seasons, company will pay only small dividend. Those companies will follow this method. Small dividend plus extra dividend. Small dividend will be paid in other seasons and extra dividend will be paid only those seasons company will be having more sales. So those companies will follow small dividend plus extra dividend. As a percentage of market value, dividend is directly correlated to the market value. Most of the companies, listed companies, joint stock companies, okay, all big companies following this method as a percentage of market value, because main aim is increase the wealth of the shareholders. To increase the market value is only the main objective of wealth maximization. If market value increases, automatically dividend also increases. If market value decreases, dividend also decreases. The main aim is to increase the market value. So most of the companies follow the percentage of market value. There are the different types of dividend policies. Okay, next, what are the different forms of dividend? Cash dividend, scrip dividend, bond dividend, property dividend, bonus shares. There are the various forms of dividend. What is the cash dividend? Dividend will be paid in the form of cash. What is scrip dividend? What is bond dividend? So scrip dividend and bond dividend both are same, but scrip dividend will be paid in the future and bond dividend will also be paid in the future. Okay, it is in the form of certificate. Dividend will be paid in the form of certificate because company already earned profits, but company is not having cash position. Company is not having good cash positions because whatever profits earned, it is in the form of bills receivables, debtors. It will take time to convert bills receivables into cash. Bills receivables into cash. For that purpose, company will issue a scrip dividend or bond dividend. What is the difference? Both are in certificates, but only difference is scrip dividend is having maturity period. Bond dividend is also having maturity period, but it can maybe postponed. Scrip dividend, whatever maturity period mentioned on the certificate, they have to pay dividend on that particular date. Okay, and bond dividend, they can postpone the dividend, but along with the interest. They have to pay interest. Okay, whatever the days they postpone. Okay, suppose company they postpone 15 days, 20 days, 1 month, they have to pay dividend for those days. Okay, so that is scrip dividend and bond dividend. Property dividend, real estate companies and all following property dividend. So shareholders, if suppose they have plenty of flats, property, real estate sites, so they're having, so they'll issue sites as a dividend. Bonus shares. So bonus shares means they pay dividend paid in the form of shares.
especially to the existing fully paid up shareholders. So they are the form of dividends: cash dividends, scrip dividend, bond dividend, property dividend, and bonus shares. Okay, next is working capital. So what is working capital? Working capital is the funds required to manage the day-to-day operations of the business. Working capital is equal to current assets minus current liabilities. So current assets includes cash, stock, debtors, prepaid expenses. Current liabilities includes creditors, bills payable, outstanding expenses, bank overdraft. What are the main components of working capital? Cash management, inventory management, receivables management. Working capital is the funds required to manage the day-to-day operations of the business. Working capital is the difference between current assets and current liabilities. Okay, working capital includes current assets and current liabilities. What are the main components of working capital? Cash management, inventory management, and receivables management. What are different types of working capital? Basis of time: permanent working, fixed working capital, temporary working capital, gross working capital, net working capital. What is gross working capital? Total amount of funds invested in current assets is known as gross working capital. What is net working capital? It is excess of current assets over current liabilities. Excess of current assets over current liabilities is net working capital. Total amount of funds invested in current assets is known as gross working capital. What is permanent working capital? Fixed working capital? It is the minimum amount of funds invested in current assets. Whatever the situation, this amount is required. Minimum amount of funds invested in current assets is known as fixed working capital. What is temporary variable working capital? So it is additional working capital. Only seasonal requirements, company required more. It varies according to the seasons. That is variable working capital. Okay, permanent working capital, temporary working capital, gross working capital, net working capital, and negative working capital. What is negative working capital? Excess of current liabilities over current assets. Opposite to net working capital is negative working capital. So what is cash management? Cash management, as the word suggests, it is the optimal utilization of cash to ensure maximum liquidity and maximum profitability. It refers to the proper collection, disbursement, and investment of idle cash. The cash management is management of inflow and outflow cash. Okay, what are the main objectives of cash management? Transactionary motive, precautionary motive, speculative motive, and compensatory motive. What is compensatory motive? Anybody? What is compensatory motive? So these are the main objectives of cash management: transactionary motive, precautionary motive, speculative motive, and compensatory motive. Anybody can start in the box. Anybody knows answer? What is compensatory motive? Or any motive? Transactionary motive, precautionary motive, speculative motive, and compensatory motive. What is compensatory motive? Okay, 1 second. Just weird. Hello, yes, sir. Hello. 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 Okay. Yeah, correct. So, Charu message banking charges, some charges on card could be example. Yeah, exactly. Compensatory motives. So, maintaining minimum balance in the account. Maintaining minimum balance in the accounts. So, maintaining minimum balance in the account is a compensatory motive. So, you have to sacrifice some money to get some benefits. Bank overdraft. You have to maintain minimum balance in the current account. So, then only you can overdraw the accounts. So bank overdraft is the best example for compensatory motive. Or maybe a savings account, you have to maintain minimum balance in the savings account so that you can deposit whenever you want, you can deposit, whenever you want, you can withdraw. That is your money. So to maintain minimum balance is a compensatory motive. To avail some services, you have to sacrifice some money. So bank overdraft, cash credit, okay, current account is a compensatory motive. So what is transactionary motive? So some funds required to manage day-to-day operations. We need some money to manage day-to-day operations. That is transactionary motive. What is precautionary motive? Precautionary motive is to meet uncertainty, to meet uncertain expenses. We need some money. That is precautionary motive. What is speculative motive? So to take advantage, we need money. That is speculative motive. Example? What is speculative motive? Any example? To take advantage, we need money. To gain some funds, to gain some money, we need some money. Example for speculative motive? To take advantage, we need funds. We have to maintain some balance in the company. Anybody? Exactly. Suppose, okay, raise in the price if goods, okay, to meet uncertainties, precautionary motive. That is precautionary motive. Correct. Correct. I am asking about speculative motive. How you can take advantage if say if you are keeping some amount of funds in the organization? Very simple. Suppose sellers are going to sell products on cash basis. Okay, if you are paying cash on purchasing of raw materials, okay, you'll get some discounts, cash discount. This benefit is available only when you are purchasing goods on cash basis. If you are purchasing on a credit basis, no discount. To avail the discount, we have to pay immediately. To avail cash discount, okay, that is speculative motive. To avail, okay, benefit on the transaction, we need some money. That is speculative motive. To take advantage, that is cash discount by the seller. Okay, these are the 4 objectives of cash management. So inventory management is a system. Okay, inventory management is a systematic approach. Sourcing, storing, selling, inventory. Okay, in business, some inventory management means right stock at the right levels, in the right place, at the right time, and at the right cost as well as the price. Okay, inventory management means managing of inventory, both raw materials as well as finished goods. Inventory is not only nothing but raw materials. Inventory is nothing but raw materials. Okay, raw materials, stock of raw materials, stock of finished goods, stock of semi-finished goods, work in progress. All comes under inventory management. Okay, what are the objectives of inventory management? To ensure continuous supply of materials, to maintain sufficient stocks of raw materials, to maintain sufficient finished goods for efficient customer service, to minimize the cost, to maintain optimum level of investments in inventory. So, these are the objectives of inventory management. So, I'll go through the fastly because we have already it's 6 o'clock. We have to discuss some questions also. Techniques of inventory management is ABC analysis, VAB analysis, IFS analysis, fixation of levels, just-in-time, inventory valuation. Okay, ABC analysis means based on the value of the material, materials are categorized based on the essentiality of the materials. VD, vital, essential, and desirable analysis based on the movement in the production, fast, slow, and non-moving analysis. FSN analysis, fast-moving items, slow-moving items, non-moving items. And fixation of levels means minimum level, maximum level, reorder level. Okay. So these are technique of inventory management. Just-in-time technique, only when order is there, they are going to procure raw material. Just-in-time technique, best example is Toyota. Toyota following just-in-time technique. Okay, so whenever you have order from the customer, you are going to procure raw material and produce the product and deliver the product. No inventory at all. That is just-in-time technique. EOQ also there. EOQ, perpetual inventory, where there are so many techniques are there. I mentioned only a few. Inventory valuation is periodically you have to value the inventory. Yeah. EOQ, economic order quantity is also there. Yeah, economic order quantity is also part of fixation of levels. Yes. Economic order quantity is also a part of fixation of levels. Minimum order, maximum order, okay, reorder level, economic order quantity. Okay, all comes under fixation of levels. So next, computation of working capital. There are 2 term methods: traditional method and operating cycle method. Traditional method is current assets minus current liabilities. Operating cycle is the average period of time required for a business to make an initial outlay of cash to produce goods, sell the goods, sell the goods, okay, and receive cash from the customers in exchange for the goods. What is operating cycle? Very simple, conversion of cash into cash. That is operating cycle. So working capital is the difference between current assets and current liabilities under traditional method. Under operating cycle method, okay, it is conversion of cash into cash. So what is operating cycle? See, company is having cash, they are going to purchase raw materials. If they are purchasing raw material on credit basis, accounts payables arises. If they are purchasing raw materials on cash basis, okay, directly purchase of raw materials, then work in progress, then finished goods, then sales. If they are selling on cash basis, directly cash. If they are selling goods on credit basis, accounts receivables arises, then convert it into cash. This is okay. Operating cycle method. So operating cycle method is conversion of cash into cash. Okay. So to compute working capital, we have two methods. One is traditional method and operating cycle method. Okay, we'll go to the questions so you can answer. If the present value of cash inflows are greater than the present value of cash outflows, the project would be accepted, rejected with condition, rejected with approval, rejected. What is the answer? First, remember guys. It's already 6 o'clock. Yeah, answer is A. Because present value of the, what is NPV? NPV is present value of cash inflows and present value of cash outflows. If present value are more, the cash outflows are less, automatically NPV is positive. What is the criteria to accept the project for NPV is it should be positive. What is the accept and reject criteria for net present value method is positive. The difference between present value of cash inflows and present value of cash outflows should be positive. If when it will be positive, if the cash inflows are more and cash outflows are less, okay, it is positive. Then you have to accept the project. For second one, please match the following. Dividend, stock, reserve, depreciation, portion of current assets, fixed liabilities, portion of profits, surplus, charge against profits. Okay, I'll give you the options. These are the list one items, list two items. The options are this. So what are the options? Tell me the answer. So options C, correct, 3. Option C is the correct answer. Option C is the correct answer. 3145. 3145. Dividend is the portion of the profit. Stock is the portion of current assets. Dividend is the portion of profit. Stock is the portion of current assets. And reserve is the surplus. And last one is depreciation is charge against profit. So answer is C. Okay. Answer is C. 3145. Okay. So next question is, the portion of earnings which is distributed among shareholders in the form of dividend is called. The portion of earnings which is distributed among shareholders in the form of dividend is called which ratio? The portion of earnings yield ratio. Wrong answer. Earnings yield ratio, retention ratio, payout ratio, stock turnover ratio. Yeah, correct. Payout ratio is the correct answer. Retention ratio is nothing but how much company earned profits, how much company is retained. It shows the relationship between retained earnings and total profits. Retention ratio is the relationship between retained earnings and total profits. What is earnings yield ratio? Total earnings and capital. Earnings yield ratio means how much earnings company earned to compare the capital is earnings yield ratio. How much yield on capital is earnings yield ratio. Comparing earnings and capital is earnings yield ratio. Retention ratio is retained earnings and profits. Payout ratio is nothing but it shows the relationship between dividend and profits. It is the relationship between dividend and profit. The portion of earnings which is distributed among shareholders in the form of dividend is called payout ratio. How much company earned profits, how much company is paid, that is only known as payout ratio. Answer is C. Okay, from the following techniques of capital budgeting decision, indicate the correct combination of discounting techniques. Correct combination of discounting techniques. Which are the current combination of discounting techniques? There are 4 techniques: profitability index, net present value, accounting rate of return, internal rate of return. Which are the discounting techniques? Correct combination of discounting techniques. Message me, guys. Which are the current combination of discounting techniques? Option A 1, 3, 4. Option B 1, 2, 4. Option C 2, 3, 4. Option D 1, 2, 3. Which one? Okay, Charu only messaged. Charu, correct answer. Anybody? Anybody? The option B is correct answer. The profitability index is a discounting technique. Net present value is a discounting technique. Okay. Internal rate of return is a discounting technique. 1, 2, 4 is the correct answer. B. Okay. Third one is traditional technique, accounting rate of return. Here, what is the difference? Main difference is time value of money. Profitability index, net present value, and internal rate of return. We are going to consider time value of money. That is the why discounting technique. And accounting rate of return, no discounting, no time value of money. Time value of money is not considered, only traditional technique. Okay, financial leverage is measured by financial leverage is measured by the formula. Please fast, guys. Financial leverage is measured by option 1, contribution by EBIT, contribution by EBT, EBIT by contribution, EBIT by EBT. What's the answer? Financial leverage is measured by. Financial leverage is measured by. Yes, answer D is correct. Only 2 are messaging. Others I don't know. Sleeping partners. EBIT by EBT is the correct answer. Financial leverage is measured by EBIT, earnings before interest and tax, divided by EBT. EBIT by EBT is the correct answer. Okay, next, financial management concerned with all aspects of acquiring, utilizing financial resources of the firm's activities, arrangement of funds, efficient management of every business, profit maximization. So which one is the correct answer? A, B, C, D. Financial management concerned with. Financial management is concerned with. Anybody? Correct. So both are mentioned. A is the right answer. All aspects of acquiring, utilizing financial resources for firm's activities. So acquiring, utilization means everything will come. Arrangement, efficient management, profit maximization, everything will come. So acquiring and utilization of financial resources is the main function of financial management. Option A is correct answer. So working capital management is concerned with. Working capital management is concerned with. Answer A. Answer A is correct. Short-term assets and liabilities. Short-term assets and liabilities. Correct. Option A is correct answer. The company's average cost of capital is. Option A, average cost of equity shares and debentures, average cost of equity preference shares, average cost of shares and all sorts of long-term funds, average cost of short-term funds. What is the answer?
It is concerned with short-term assets liabilities. 7 in the A.
Option A, right? Hello? Option A is correct. Dr. Vidya? Right answer?
Answer kuttavadta A. Vidya correct.
Correct, correct. Short, A, answer. A is correct. A is correct. Short-term assets and liabilities.
Average cost of capital, average cost of equity share and debenture, average cost of
The
equity
company
preference,
have, eighth question, right?
average
Eighth
cost
question.
of shares and all sources of long-term funds. C.
8 is C, 8 is C, correct. Who is this?
C.
Hello? Question 8 is, C is the correct option, correct. The average cost of shares and all sorts of long-term funds. The average cost of capital is the cost of all the capital. Total capital includes equity shares, preference shares, debentures, retained earnings, public deposits. So it is the average cost of all the capital. That is option C is correct. 8C is correct, not the A. Okay. So cost of retained earnings equal to, next, only two questions. Cost of retained earnings equal to cost of equity, cost of debt, cost of bank loan, cost of term loans.
Retained earnings, cost of equity, debt, loans. A.
Correct answer A. Why A?
Equity.
Why equity? Why equity is the correct answer? Why not cost of debts? Exactly correct. Retained earnings. Suppose company go for expansion, diversification after some times. Okay, the company want to expand means they are going to convert. Earnings into. They are going to convert earnings into capital. They are going to convert earnings into capital. So how they are going to convert? How they are going to convert capital? So they are going to issue bonus shares. Whom they are going to issue bonus shares? Equity shareholders. Exactly correct, Charu. Correct. Right answer. Equity shareholders. Because whenever company go for expansion, they are going to pay bonus shares to equity shareholders only. Okay. That's why cost of retained earnings equal to cost of equity. Okay. EBIT is also known as, very simple, operating profit. So by this we come to end. Okay. Thank you very much. So all the best, guys. Tomorrow we have 1:30 session. Please log in before 1:30. Okay. Um, by sharp 1:30 will start. Okay. So thank you very much. Okay, thank you everyone. All the best for your exams. Okay, see you tomorrow. Okay, bye.